Good morning, bulls and bears. Let's walk through the key market moves shaping today's session. From a weakening US dollar to geopolitically supported oil, a historic breakout in gold, and renewed strength in the Australian dollar. Here's what matters and how the charts line up. The US dollar index has slipped below 98, trading near 97.8, its lowest since early October. This move is being driven by rising expectations of further Federal Reserve rate cuts next year, which continues to erode the dollar's yield appeal. The dollar has also weakened against the yen and the euro, with the yen rebounding after strong intervention signals from the Japanese officials. As a result, the dollar index is now on track for its biggest annual decline since 2017. From a technical perspective, price is trading below the 100-day simple moving average at 98.6, which now acts as near-term resistance. This keeps the short-term bias slightly bearish. Momentum indicators reflect this weakness. The RSI sits near 33, well below the midline, while MACD remains negative, though bearish pressure is easing. A daily close above 98.6 would relieve downside pressure and shift focus towards 99. Failure to reclaim that level keeps path open toward 97.87 and potentially 97.46 if sellers remain in control. Crude oil is trading around $58.3 per barrel, up nearly 4.5% on the week. The rally is being fueled by escalating geopolitical risks. Over the weekend, the U.S. Coast Guard intercepted another sanctioned oil tanker near Venezuela, raising renewed concerns about supply disruptions. At the same time, Ukrainian drone attacks in Russia have increased risks to the Black Sea energy exports. Markets are now taking these risks far more seriously than before. Technically, however, oil remains in a weak and volatile structure. The $56 level is key short-term support. A break below it opens the door toward $54.88. On the upside, the 58.8 to $59 zone near the 50-day moving average is heavy resistance. Only a clear breakout above $60 would signal a meaningful trend shift. For now, oil appears locked in a low-level consolidation with limited rebound potential unless fundamentals escalate further. Gold continues to steal the spotlight. Spot gold is trading nearly $4,490 per ounce after surging to new all-time highs. This breakout is driven by two powerful forces. First, safe haven demand has surged following President Trump's announcement of a blockade on sanctioned Venezuelan oil tankers. Second, the market is increasingly pricing in the possibility of a more dovish Federal Reserve leadership, with expectations of future rate cuts strongly supporting non-yielding assets like gold. A weaker US dollar and thin holiday liquidity have amplified this move, creating a classic momentum breakout. Technically, gold has turned former resistance near $4,400 into support. As long as price holds above the $4,400 to $4,380 range, the bullish structure remains intact. However, the RSI is deep in overbought territory, nearly 79, which suggests short-term upside is becoming crowded. Rather than chasing, the market is more likely to digest gains through high-level consolidation or a sharp but controlled pullback. Looking ahead, $5,000 is now firmly on the longer-term radar. The Australian dollar is trading near 0.67, its strongest level in nearly 3 months. This follows a hawkish undertone in the RBA's December meeting minutes, where policymakers acknowledged that inflation may be more persistent than expected, and even discussed the possibility of rate hikes in 2026. On the charts, the Australian dollar against the US dollar has broken higher, with the RSI near 68, signaling building bullish momentum. As long as price holds above 0.664, the bias remains to the upside, with 0.676 as the next key target. A break back below 0.66, however, would weaken this outlook. To sum up, the dollar remains under pressure, oil is supported but technically fragile, gold is in a powerful but crowded uptrend, and the Australian strength reflects shifting global rate expectations. As always, manage risk carefully, especially into year end liquidity conditions. Thanks for watching, and I'll see you in the next update.